Right now, silver is trading around 70-90 per ounce on COMEX, down slightly in thin holiday markets. But the real story is in T, the price you see on screen. It's the disconnect between paper prices and physical supply, driven by China's new export controls and global demand. That's squeezing the market in a way we haven't seen in decades. Ladies and gentlemen, Jason here. Today, we reanalyzing deeper why silver just broke the system this week, and why the market you re-watching and the market that EOS actually shaping prices are no longer the same thing. If you're tracking silver right now on your brokerage app, you re-seeing prices hovering near 71 per ounce on COMEX, still reacting to year-end liquidity and CME margin changes. But that number alone doesn't tell the whole story. What matters more is the bigger underlying shift that's been building for months. China's export control regime is kicking in, physical premiums continue to rise in global hubs, and markets structurally starved for metal are behaving very differently from paper markets. That is the real breakout. And it's why we're seeing a fracture in price discovery. Silver isn't behaving like a normal commodity anymore. The disconnect between physical and paper is real, measurable, and widening. And while Western markets slept through the holidays, the supply reality didn't. Here's the thing most investors overlook. Price is the result of supply and demand, not the cause. If there were abundant silver sitting in vaults, you wouldn't see this kind of behavior. Paper markets would arbitrage the gap, but we aren't seeing that. Right now, physical silver premiums, the price people are actually paying for metal they can hold in their hands, are significantly higher in Asia and Middle Eastern hubs than the COMEX contracts suggest they should be. And that tells you something important. It tells you there's a structural shortage building, not a temporary blip. Let's slow it down and walk through what's actually shifting beneath the surface. For decades, silver pricing was dominated by paper derivatives, futures, ETFs, and contracts that promised delivery later. That's fine when supply flows freely. When metal is fungible and transportation works, paper and physical prices converge. But when supply gets choked off, when a major producer controls the physical flow, that mechanism breaks. That's exactly what's happening with China. They've quietly shifted toward export licensing requirements on silver. On paper, it sounds like red tape. In reality, it throttles how much metal can leave the country. When a major supply hub restricts exports, the immediate impact shows up in physical availability, not in thin paper markets. Factories still need metal. Solar panel producers still need it. Industrial demand doesn't take holidays. And that demand just keeps growing. When the people who actually use silver start paying up to secure inventory, that's not speculation. That's survival. Silver isn't just a shiny metal anymore. It's a critical industrial input. And here's where your standard silver price chart starts to make less sense. When physical buyers, the ones who actually plug metal into production lines, start paying a real premium, the market begins to split. On your screen, paper traders are chasing the next candle. But in the real world, buyers are paying whatever it takes to get metal today. That's just why the paper price can sit near $71 while physical markets are signaling $80, $82, $84 and climbing. These aren't random numbers. They're the prices actual buyers are paying for metal that can be delivered now. And when physical demand diverges from paper pricing, the paper markets stop being the price setter. They become a lagging indicator, a ghost of what real supply and demand dictate. We're not talking about 6 months out or some theoretical deficit. We're talking about right now, trading days, where physical inventories are tightening, premiums are rising, and buyers are scrambling. And the data supports this. Shanghai future settlement prices and global premiums are signaling stress that COMEX prices haven't fully priced in yet. This is why I say silver broke the system this week. Not because the paper price spiked wildly, but because the relationship between paper and physical has fractured. And fractured markets don't heal quietly. Now, we're going to walk through the three-tier price reality that's forming. What's happening in Shanghai, what's occurring in the Middle Eastern physical markets, and why New York's paper price is now an outdated reference point. Once you see that, you'll understand why traditional price tracking is no longer telling the full story. What is happening right now only makes sense once you stop thinking of silver as a single market. Because it isn't anymore. We're looking at least two different realities running at the same time, and they're drifting further apart by the day. On one side, you have the paper market, COMEX, futures contracts, options, ETFs, highly liquid, highly leveraged, and heavily influenced by positioning, margins, and short-term flows. On the other side, you have the physical market, bars, coins, industrial supply, long-term contracts, less visible, less liquid, but ultimately the side that actually decides whether silver exists or not. For a long time, these two stayed aligned. If paper prices dipped too far, physical buyers stepped in. If physical demand cooled, paper markets adjusted. That balance is breaking, and the reason is simple. Physical silver is no longer abundant. Look at how buyers are behaving right now. Industrial consumers aren't waiting for better prices. They're not trying to time the market, they're securing supply. That's a very different mindset from a trader clicking buy or sell on a screen. When you run a factory or a manufacturing line, silver isn't an investment, it's an input. If you don't have it, production stops. So when availability tightens, price becomes secondary. That's why premiums matter more than spot price right now. A rising premium tells you something critical. It tells you that metal is scarce where it's actually needed. And this is where China's role becomes impossible to ignore. China isn't just a big consumer of silver, it's a key node in the global supply chain. When metal slows down inside that system, the ripple effects travel fast, but they don't show up evenly. They show up first where metal is being pulled, not where paper is traded. This is why Asian markets have been quietly absorbing supply, while Western markets look calm. It's not because demand disappeared, it's because the stress hasn't been priced into the paper yet, and paper markets are always the last to adjust. Here's something else that matters. Silver inventories aren't like oil inventories. You can't just open a valve and increase output overnight. Most silver is mined as a byproduct. Copper, zinc, lead. That means higher silver prices don't instantly bring more supply. They don't even guarantee more supply in the medium term. So when demand rises and supply tightens at the same time, the system doesn't rebalance smoothly. It snaps. That snapping doesn't always look dramatic at first. Sometimes it looks like nothing. Flat price, low volatility, holiday trading. But underneath, positioning starts to strain. Shorts becomes more nervous. Delivery obligations become more expensive. Arbitrage becomes harder. And at some point, the cost of maintaining the illusion exceeds the benefit. That's when you see sudden repricing. Not because something new happened, but because reality finally forced its way into the price. This is why silver's behavior this week matters, even though it didn't look explosive. The system didn't break loudly, it cracked quietly. And those quiet cracks are the most dangerous ones, because most people don't notice until they widen. There's also a psychological shift happening. For years, silver was treated like a secondary asset, something to trade around gold, something volatile, speculative, easy to dismiss. That perception is changing. As industrial demand grows and supply becomes more controlled, silver starts behaving less like a trade and more like a strategic material. And strategic materials don't obey the same rules as financial assets. They don't care about sentiment. They don't care about charts. They don't care about holidays. They move based on need, and need doesn't negotiate. That's why watching only the COMEX price right now is misleading. It tells you what traders are doing, not what the world is demanding. The real signal is coming from behavior, from who is buying, from how urgently they're buying, and from what they're willing to pay. That behavior says the system is under strain, not collapsing, not panicking, but tightening. And when systems tighten, they don't relieve pressure gently. They release it all at once. There's a mistake a lot of people make when they look at silver right now. They assume that if the price hasn't exploded yet, nothing serious is happening. That assumption is dangerous, because markets don't move when everyone agrees. They move when pressure becomes impossible to contain. And right now, pressure is building in places most investors never look. Start with inventories. Reported stockpiles give the impression that there's plenty of silver available, but those numbers don't tell you how much of that metal is actually deliverable, unencumbered, and ready to move. A large portion of silver inventory is already spoken for, allocated, promised, tied up in long-term industrial contracts. That means the margin for error is thin. When supply chains get stressed, thin margins disappear quickly. This is why delivery timelines matter more than headline inventory numbers. When buyers start accepting longer waits or paying premiums to avoid them, the system is signaling strain, and we're seeing that now. Another overlooked factor is how leverage works in the paper market. Paper silver trades at multiples of the physical supply. For every ounce that exists, many more ounces are promised on paper. That works as long as most participants don't ask for delivery at the same time. But when physical demand increases and supply tightens, that confidence weakens. You don't need a mass rush for delivery to cause problems. You just need enough participants to question whether delivery will be smooth. Once that doubt enters the system, behavior changes. Short sellers become more cautious. Market makers widen spreads. Liquidity thins. None of this shows up immediately in price charts. It shows up in how the market reacts to stress. Moves become sharper. Reversals become faster. Volatility spikes without warning. And those are early signs of a system adjusting under pressure. Another important shift is where silver demand is coming from. This isn't just retail investors stacking coins. This is industrial demand tied to long-term trends, energy infrastructure, electrification, data centers, defense, and advanced manufacturing. These sectors don't reduce consumption just because prices rise. They adapt by locking in supply. That creates a feedback loop. As more supply gets locked away, less is available for the open market. As availability drops, premiums rise. As premiums rise, confidence in paper pricing erodes. That erosion doesn't happen evenly. It happens quietly, then suddenly. This is why silver feels calm right now while simultaneously being unstable. The market is in a holding pattern. Participants are watching each other, waiting to see who moves first. But structural issues don't resolve themselves by waiting. Eventually, something forces a repricing. It could be a delivery disruption. It could be a policy shift. It could be a surge in industrial demand. Often, it's something small that exposes a big imbalance. When that happens, price doesn't adjust gradually. It jumps. And when it jumps, it doesn't ask for permission. This is what people mean when they say silver is a sleeping market. Not because nothing is happening, but because the buildup happens quietly below the surface. The system is still functioning. Trades are clearing. Charts still look normal. But the conditions that supported that normalcy are changing. Supply is tighter. Demand is stickier. Control over physical flows is more concentrated. That combination doesn't lead to stability. It leads to repricing. And when repricing comes, it rarely gives you time to react. That's why paying attention now matters. Not because you need to panic, but because understanding where pressure is building helps you avoid being surprised when the release comes. The silver market isn't broken in the sense that it's stopped working. It's broken in the sense that it's no longer telling the truth cleanly. And markets that stop telling the truth eventually correct themselves, all at once. So where does that leave us right now? It leaves us in a market that still looks calm on the surface, but is clearly under strain underneath. Silver hasn't broken in a dramatic way. It hasn't gone vertical. It hasn't collapsed. What it's done is more important. It's stopped behaving the way it used to. For years, silver followed familiar rules. Paper-led, physical followed. Price action reflected sentiment more than necessity. That relationship is changing. Physical demand is asserting itself again. Not loudly, not emotionally, but consistently. And consistency is what reshapes markets. When supply is easy, price discovery is clean. When supply tightens and control over flows increases, price discovery gets distorted. That's what we're watching unfold. China's role in this isn't about headlines or politics. It's about leverage. Controlling physical materials gives you leverage, especially when those materials are essential to modern infrastructure. This doesn't mean prices explode tomorrow. It means the old assumptions no longer hold. It means dips don't mean the same thing they used to. It means volatility will likely increase. It means sudden moves become more likely than smooth trends. For investors and observers, the biggest risk right now isn't being wrong. It's being unaware. Unaware that paper prices are lagging signals. Unaware that physical behavior matters more than charts. Unaware that structural shifts don't announce themselves politely. Silver is teaching a familiar lesson, just in a quiet way. When the foundation changes, the structure above it has to adjust. That adjustment can take time, but once it starts, it doesn't stop halfway. This is why I wanted to talk to you today. Not to hype, not to scare, but to make sure you're looking at the right things. Watch availability, watch premiums, watch behavior, not just price. Those signals tell you where the market is going before the chart catches up. And as we move deeper into this year, those signals are going to matter more, not less. I'm curious what you're seeing. Do you think silver is still being priced like a financial asset? Or do you think the market is starting to treat it like a strategic material? Drop your thoughts in the comments. I read them all. If you found this useful, share it with someone who watches markets closely. And if you want clear, grounded analysis without the noise, subscribe here at JW Capital. This year is going to test a lot of assumptions. Let's make sure we're not holding on to the wrong ones. Happy New Year once again to you and your family from JW Capital. I hope this year brings you health, clarity, and smart decisions. I'll see you in the next one.